Evening, everyone. Thanks for joining. So my name's Ian Humphreys. I'm joined by development finance expert and industry legend Tim Noble. So thanks for joining. John's on the call as well. So John works in our marketing team. So
hi, John.
Here to man any questions along the way. So we've got a few sort of latecomers popping along now, so we'll get started in a second. But I'm assuming this everyone can see our screen. So this is who I am. This is who Tim is. So I've been a property developer and a broker most of my career. So I know the challenges from both sides as to how difficult it can be to find the right funding. But also just navigate the market in general. You know, there's a lot of ways that you can get ahead as a developer in this industry. And by knowing them, you know, you set yourself apart from the competition and just get ahead sooner. So that's what really we're all about, is kind of sharing our knowledge, sharing our experiences to try and help you grow your business. Tim, do you want to give us a quick 30 seconds?
I come from the other side of the desk, which is a lender turned broker or advisor. We have got 35 lenders on the platform. Someone needs to speak their language. I was brought on board to be that liaison between the lenders that we've onboarded and the developers. Having been a lender of development finance with a number of the London banks, I know what they're looking for. I know what they don't want to hear. I know that they like a well-presented application, and it's my aim to turn your deals into applications that will fit the right lender at the right time. And it's that experience that we impart to you.
Yeah, it's a really good point, actually. We were talking about this the other day. One of the things that we talk about when we onboard lenders to Brickflow, so they go through quite a structured process. We don't just let anyone come on. You can see the lenders we have on the system at any time. They're all available on the website. All the names are there. But what we are quite rigorous about is the type of lender that comes on. So you know, we don't have every lender in the industry purely because not all of them deserve business. There are some cowboys out there still, unfortunately. But what we're very careful to do is make sure lenders that come on are reputable, have decent, secure funding lines. We don't want any lenders sort of disappearing partway through your project, because you know that's going to be disastrous for you. So yeah, we're very keen to make sure we've only got the best lenders. But when we do onboard lenders, we ask them how many inquiries do they see to every loan that they fund, and the answer to that question varies enormously, but a kind of number that people agree on is 1 in 25. So out of every 25 inquiries a lender gets in this industry, they complete one loan. So just that stat alone, 96% of all inquiries are not getting funded by lenders. Then you need to start thinking about how you stand out. You know, how do you get to the top of that lender pile? And you do that by presenting, you know, a high-level presentation, which is exactly what Brickflow does. It guides you through that process, so the lender gets exactly what they need to make a decision. But also, it's about yourself. You know, going through the process of where the risks are in any project, where are the strengths, where are the weaknesses. Highlighting them, especially the weaknesses, and just being honest and upfront with the lender, just saying that we know this is a weakness, but this is how we're going to mitigate. So this is some of the things we're going to cover tonight. So this is specifically about permitted development. So permitted development has been great for the industry. I think for all property developers of all sizes. Permitted development is something you can get into relatively quickly, pain-free. You haven't got the planning complications that you have of perhaps of a new build scheme, and it's something that first-time developers can get into as well. And we're going to give you a bit of guidance on that if you're newer to development. But I think that the overriding thing is the pitfalls that, you know, even the most experienced developers find themselves or get themselves into by not understanding how the funding works for permitted development is definitely different to new build. And that's mainly just around the sort of maths and logistics of calculating development loan. So we'll go into that in a bit more detail. This is also a great session for advisors. So if you're a broker or an accountant, somebody who works with property professionals, property developers, and you're looking to expand your knowledge and so you speak more their language and be able to add value to them, then this is something that hopefully will add value to you as well. So just a quick bit on us for those that don't know us. So I say our core mission is to help developers do more with less. What we mean by that is, and we talk about in point 3 as well, is inefficient equity deployment. This is the sort of enemy of most property developers, but most don't realize this problem. If you speak to one lender, they'll give you one site and they'll give you one loan option. If you speak to another lender, they give you another loan option. So multiply that across the industry. There's not a single lender that is going to lend to you on exactly the same terms. And the majority are going to give you a different loan amount. You might find some lenders are coming in at similar loan amounts, but they're all going to offer different pricing. So there's huge margins here. And, we're not talking about like when my mum used to search for car insurance 20 years ago. I remember sort of watching her on those, probably a bit longer than 20 years ago, 25, 30 years ago, when, once a year she'd ring around car insurance for the day and save herself 20 quid. We're talking tens of thousands and hundreds of thousands of pounds in most cases. And that's a combination of the deposit that's being put in that perhaps isn't necessary. There might be a better, more efficient equity position in the market, and also the pricing. So this is what we're here to do, is show people that actually they can do more with less. We want developers to get the best value of funding each time. There are it doesn't matter who you speak to, you could be the most experienced developer in the world or brand new to the industry. There will always be an opportunity to improve on your current relationships and the offerings that you're finding. Point 4, so our sort of thinking is if we can increase efficiency within loan procurement. So what we mean by that is lenders, as we just highlighted, 1 in 25 inquiries, so 96% of inquiries are going nowhere. Imagine that as a job. 96% of the things you look at are never going to go anywhere. It's a hugely inefficient industry for both lenders and for borrowers. And if we can do anything to improve that efficiency, it means it's cheaper for the lender to procure loans, which means they can drop the cost of their development finance. If they drop the cost of their finance, then development loans get cheaper and more houses get built. So that's really where we're coming at this from, is to help advisors, brokers, to help developers, and also help lenders, for everyone to have a better infrastructure and ecosystem to play in. So these are the PDR rules. I mean, most of you, I hope, are fairly familiar with these. So 2013 was the first sort of major change, and that was followed by August 2020, extensions of up to 2 stories being allowed. And then there was a wider change in September 2020, which is the commercial retail premises Class C to mixed use was permitted. And then in 2021, new PDR conversion for Class E and Class 3 residential use was introduced, sorry, C3 that should say, was introduced and known as the Class MA right. And my final point on that slide is beware of minimum spacing, which Tim is going to chat us through.
Yeah, clearly with a let's take a typical office to residential conversion. It's got 4 walls and ceilings and floors. You can carve it up any way you like, and most developers are looking to get the maximum number of flats. But if you were, the rules have changed. They used to be mortgageable. Council of Mortgage Lenders, the CML, said that anything less than 30 square meters, they wouldn't grant a mortgage on it. Now, if you're building flats to sell and your purchaser can't get a mortgage, you won't be able to sell them. So it doesn't matter how many units you think you can fit in there. They're now saying that this should be 37 square meters gross internal area, and you've got to optimize the space that you've got. You can't move the 4 outside walls, so somehow you've got to design or get a top architect to design a layout that will maximize the space whilst not compromising the minimum requirements for mortgage purposes. Otherwise, unless you personally are going to hold them and rent them, your buyers, if your way out is a buy-to-let or a mortgage, then the mortgage lenders want to see the minimums. There's also, I'll just butt in really with myself, there's also the newer requirement for natural light. You can't put a flat in the middle of a square office with no windows. They won't allow it. So it's got to have adequate natural light. And that's an interesting one we might talk later about. Buildings that were not fit for resi, the windows are in the wrong place. You've got fenestration issues, which is what we call a technical word for windows. If the windows don't match where your architects draw the plans, you've got half windows shared between flats. Can get very messy. So a good quality architect, I think, is essential to draw up a scheme that's attractive but makes best use of the space that you've got.
Yeah, it's not immediately straightforward with a lot of these units. I mean, the point with the mortgageability is if the high street won't mortgage those end units, a development lender will not lend to you, because for a development lender, their exit is always sale. You know, that's one way they get out of that loan. And if there's no end users that can get mortgages on your units, then that exit disappears. So as Tim rightly says, there is, if you are planning to hold them, then some lenders will be flexible with that, allow you perhaps to come under the minimum spacing, but you're going to need to clearly demonstrate that there's appetite on a senior, long-term senior commercial mortgage that will allow you to refinance above the amount that you're going to owe the development lender at the end. So yeah, minimum spacing is really key. And it didn't used to be as much of a problem. And I think people have bought or built things and have been called out by that. So don't be called out by that.
It was interesting. My last lending role before I joined Brickflow was with a lender that would take a view on minimum spacing. If you got permission to convert into 30, or if your drawing showed 30 flats, they might assist if, say, only 3 of them were below the minimum. They want to make sure they're going to get repaid on sufficient sales. So I wouldn't take anything for granted with any lender, but go for the maximum space. And if 1 or 2 just fall at the limit or slightly below, they might take a view, and that's something we can help you with.
Yeah. Okay. So experience. So yeah, it's something that comes up most days, I think, in conversations with developers. So experience for new build is a must. If you're building a project as a developer and you have no construction experience, so you haven't been a project manager, a builder, a QS, you don't have a construction background, it's practically impossible for you to get funding on a new build scheme. You'd have to bring in other people into the team, probably as shareholders that have that experience to get you over the line. If you have construction experience, it definitely helps, but still lenders treat personal experience and employee experience as different things. Okay, so development is, we speak to a builder sometimes, says, I've been building 20 years, but what a lender sees is someone that can build something, but doesn't necessarily able to deliver the things either side of that. So, complications with planning, the actual marketing and, delivering of the units to the market and exiting in a timely fashion. They, and sometimes, construction professionals, that they don't see that the same way, because, like I say, lenders see development as a much wider array of skills. You need to there's going to be a lot of legalities that come up in their contract, as well as planning. you know, is project management, is risk. You know, there's a lot of things there that you might not pick up just being a certain construction professional. So that's one key thing to say. With permitted development, the experience threshold is definitely lower. And that's primarily because the construction risk is the biggest risk for the lender. So if you remove that, you're, as Tim said earlier, you're reconfiguring a box that's already there. Then there's much less risk. It's a glorified refurb. Okay, so it's a great entry point for a more novice developer, or certainly a construction professional looking to come in for the first time. Tim, anything to add?
No, I was just to say, you're right. As a lender, they're looking at you, the contractor. You've been a contractor doing other jobs for other people. You've done loft conversion, you've done extensions, but you've never had to get the planning. You've never had to sell the property. You've never had to get the utilities connections. You can build excellently, and but you don't have those marketing skills. You don't have, you know. But with a PD, permitted development, you've got a building that's built. As every developer knows, the majority of the risk is in the ground. Once you're out of the ground, the boring bit, all you're doing is knocking up bricks. But so the risk is in the ground. If you take away the ground risk, I would caveat that, say the other risk, and we'll come on to risk, is the structural integrity of the building. But nevertheless, it's a lot less risk, as Ian said, a lot less risk than a ground up new build.
Yeah. So if you are coming into property development for the first time, and as we've already said, they are a great opportunity for these schemes for newer developers to get into. Then you might be asked to, well, you'll certainly be asked to build an experienced team around you, and not only should that just be for the lender, that should be for yourself as well. You know, if you've not been through that process, then absolutely you're going to learn bucket loads by having, you know, decent people around you that have. But sometimes you might find, and we see this on new build as well, but sometimes you might find lender asks for you to bring somebody into the team that is on some kind of performance incentive. So as an example, the two main people that you might bring in, one would be the contractor, and one could be a project manager. And it might be that you work with a contractor that does project management as well, and they might suffice, or it might just be a standalone project manager who then is more on your side, if you like, and managing the contractor. The key there, why lenders like to see that sort of performance incentive, is that you've got somebody who has the experience, who knows what they're doing, is basically being rewarded for delivering a scheme on time and on budget. And as I've said there in the slide, that ensures strategic alignment. Everyone wants the same outcome here. The lender wants their money back, so they want you to build it and sell it. You want your money out, so you want to build it and sell it. And the contractor wants to get paid, so he wants to build it and you to sell it. So, you know, everyone wants the same thing. And so that performance, that profit share is something that lenders all of a sudden get a nice warm feeling about. So you've got a more novice developer. If you've got a project manager that's coming in, being paid on their normal retainer rate, perhaps it's £2,000 a month or something like that, but then they stand to make a 5% profit share on the scheme in the event they deliver on time and on budget, then a lender immediately is going to feel a lot more confident that that scheme is going to get built. Timothy?
No, you're right. It's the difficulty is not about you know you can do it, but the lender doesn't. The lender can't see that you've done anything from start to finish. So bring someone in who can. Project management is a great skill. If you think about the alignment of trades, you can't take the scaffolding, you can't do the roof while the scaffolding's being erected, you can't do the rendering while the scaffolding's still up. It's all alignment. A project manager knows that. He knows a decent program, and they're worth their weight in gold, definitely. Contractor, you can see what they've done before, but they'll still run rings around you if you're a novice. Yeah,
I think that's a key point. You know, some contractors, you know, and will, you know, recognize perhaps if you're not as experienced, and, and maybe you might push their luck a little bit.
It's not what's in the contract, it's what's not in the contract, and they'll find the holes. They'll definitely find the holes, and you'll get to the end, and you'll be arguing for years about the extras.
But I think the point is, at the moment, is so much more difficult for contractors because of the rising costs, right? So everyone still wants a fixed price contract, but how can you price on a fixed price basis when you've seen some materials double in price, over the last 12 months and more? I mean, I see timber is up 230% or whatever it was in 2021. So I think prices, we hear prices are coming off a little bit in certainly some materials. So that's great news. But, for a lot of contractors, they're under a huge amount of pressure. They've taken on a few schemes, perhaps priced them fixed price during COVID, a lot of inflation. They're now looking to try and make profit on other schemes. If you haven't got a decent contract, you perhaps haven't got a decent project manager, then you might find that you're paying more than you should. A point just to make there quickly, we're about to complete a loan for a first-time developer actually on a commercial scheme in Aylesbury. And we're going to do a case study on that because it's probably a great example of what we're able to do through the platform. But this particular person was adamant he didn't want to work with a project manager. And when we went to credit committee, the lender said, look, we're not going to sanction this loan unless you have one. And they didn't insist on a profit share or an incentive or anything, but they wanted someone experienced in. And what had happened when we dug down with the borrower as to why he didn't want to, I think basically the people he'd spoken to in the past perhaps didn't really want the job, perhaps it was a bit too small for them, or it was a commercial rather than a residential scheme. So perhaps they didn't like that work as much. And as a result, they were pricing very highly, and when they were outlining their scope or what they were going to do as part of their role, he couldn't really see where the value add was. But then we sort of reached out to a couple of people we knew. He reached out further into his network, and he's actually found someone now who's like, this guy, as Tim just said, is worth his weight in gold. He's speaking, he's talking to the contractor about the right things. He's putting new clauses in. There's all kinds of things there. And as Tim said, tight project management or schedule management is crucial, because time is money on these things. If you add an extra 2-3 months to a project, it's actually you've just almost thrown away a new car in terms of profit in your scheme.
And that borrower is so organised, and yet he's never done ground up development. So he thought his organisational skills would see him through anything, but property is not. What was he doing? School uniforms or something? It was just unbelievable. But the lender said, "Suck out." And when he looked at it, he saw the reasons why. And as you say, he got a cheap deal at a reasonable fee for the work involved. So a win-win.
Yeah, I think one thing I will say is the QS on that scheme came back quicker than I've ever seen any QS come back. I think he completed his report in 3 or 4 days. And I think that is absolutely testament to how organised he was. But a lot of it was, the information that we'd given him. We said to him, and because almost it's like a blank slate when you have somebody that's newer to development. You can say to them, look, this is how you need to prepare. And when they do it, someone who perhaps who'd done 20 schemes before, and you tell them the same things, they might just ignore you. Whereas actually, it's a bit like, say, a blank canvas. When somebody comes in, you say, right, this is how you do it. And they do it. It's a lovely thing to watch. I've never known a QS ever to come back in 4 days with a full report, and that's just because he was supremely organised. My last point there about the profit share. Some people will always say, "Oh, I don't want to give profit away." You're not giving profit away. This is a stepping stone to bigger and better things. You're learning. You're bringing on people on board who can actually deliver a scheme. And I remember speaking to someone a little while ago, and who'd been on a sort of property development course, And I said to him, well, what about bringing no experience, no construction experience? What about bringing somebody on and giving them a profit incentive? He's like, oh no, my course told me not to do that. It's like, well, why? And it's just like, well, no, they just said that was unnecessary and shouldn't do that. And you know, every lender will tell you that's a good thing to do. So yes, you know, somebody else might have told you it's not, but the lender, I mean, yeah, at the end of the day, the lenders are going to make this a reality for you. So you kind of need to work with them. And so, you know, don't close anything off. And also as well, I mean, going back to that case we were just talking about, you know, the options we were getting where perhaps the project manager wouldn't be forced on him. You know, the rates were, you know, 12+%. The rate we ended up getting was closer to 8%. And so that 4% differential on, you know, £1.5 million of borrowing is quite significant. Right, okay, so what we want to do here is highlight the sort of key differences between funding PDR and new build, really. And the main difference is the weighting between the build costs and land costs. So with a new build project, the majority are either equally weighted or the build costs are higher than the land costs. So sometimes in London and the south, you find that there's equal weighting, but generally anywhere else in the country, you tend to find land costs are lower than the build costs on the scheme, okay? With PD, the reverse is almost always true. So the value of the building or what you're being asked to purchase it for is going to be greater than your build costs, okay? And this is significant because of the way development finance is calculated. So we're just going to run through a couple of scenarios here. So the way development finance is calculated, for those that don't know, a gross loan is calculated first. The lender then deducts all of their costs. So that's their interest, their fees, etc., and some professional costs. Then they deduct 100% of the build cost and the rest goes towards the land, okay? The issue is that the vast majority of lenders will have a day one land cap. Yep. So some it's 60%, some it's lower, some it's slightly higher. But the point here is that even if there is more capacity within the loan to lend you more money, that day one cap kicks in and you then actually can't access that bigger percentage of borrowing. So that means that you need a larger deposit. So here's an example. So we've got lender one says they lend at 65% loan to GDV, but that, and this is one of our bugbears, you know, lenders say, no, we do 65% GDV, we do 70% GDV, as if that's the only metric that matters. There's so many metrics that go into development finance, and this is why you get a different result from every lender. But this lender's capped at 85% loan to cost, and their day one land value, they cap at 60%. Okay, lender two also at 65%, but they can go 90% loan to cost and they have no day one loan cap. Okay, so in the following scheme, where the land cost is 1.8 million, build costs are 1.2 million, lender costs are 250k, and you have a GDV of 4.5 million. Okay, so stay with me here. I know I'm shouting a lot of numbers quickly, but the key difference is that lender one, whilst they lend at 65% loan to GDV, you would need a deposit of 720,000. Okay, lender two also lends at 65% loan to GDV, but you'd only need a deposit of 325,000. Okay, so nearly £400,000 on a 4.5 million GDV scheme. So not far off 10% of your GDV extra upfront in additional deposit, and certainly more than 10% of your total cost of the project. Tim, anything to add?
No, I was just running my calculator, just out of interest. So lender one, lender one. It wasn't that. I just lender two, 2.925 is 65% GDV. Lender one is only 50% of day one. That's a hell of a difference. And on our system, they'll both show us lending 2.925 until they, and then suddenly you hit that button and it says it's going to be, and lender one will. You'll go, what happened there? I thought you can check on any screen at the eligibility of each lender, and it will tell you these exact rules that they're running by. So don't take our word for it. It's there on the Brickflow system.
Yeah, we'll have a look at the system because it does all these calculations for you. So you don't need to remember any of this, but it's just making you aware of like the key differences. So, you know, you've got 5 lenders that are saying they all lend at 65% GDV. You know, the lazy developer speaks to one of them, says, I don't need to speak to the rest. Yeah. Whereas actually every single one of those lenders will lend you a different amount of money. And that's because they're all charged different amounts. And therefore the interest retention will be different, but that won't be a huge amount. There's these key figures here. It's the loan to cost number, it's the day one land value caps, it's the minimum equity that they want in for borrowers. Every lender has a different rule on these things, and you mix these things together, it has a dramatic impact on your borrowing capability. So, you know, for a developer perhaps who's looking at this scheme, they go and speak to one lender and they have to put 720,000 in. They think, actually, I can't do this scheme, and they pass on the opportunity, or perhaps they go to their network and raise a larger deposit, raise part of their deposit from investors and promise a profit share. Whereas, you know, a smarter developer shops the market or uses Brickflow, and you know, they walk away with a much better result, and they don't need to give away a profit share, and they walk away with 100% of the profit. So, you know,
but both of those options will be on your results screen. We're not just saying we only deal with lender 1 or we only deal with lender 2. We've got 36 lenders who all have got different rules. They can all be 65, but one might go to 85% cost, one might go to 70% day one cap. So many differences, but the matrix of our system gives you all that calculation, all done for you. All you've got to look at is what are you looking for, the maximum loan, biggest loan, or the cheapest rate. It's all set out for you. We can show you that later.
Okay, so site valuation. So this is really key. The valuer that the lender appoints, so I'm sure everyone on the call understands, but once your loan is credit approved, the lender will then appoint their own valuer and their own QS to come out. So the valuer's coming out to do 2 things: the value you're paying for the site, the value it is today, and also the end value. And they do what we call a sniff test on your build cost. So they're not going into granular detail, but they are doing a high level appraisal, working back from your GDV and saying, okay, build costs look in line with what the data we hold for this area, and therefore the residual land value is this. Okay, the QS is doing a slightly different role, where they're actually coming out and going into granular detail on the actual all the costs, the schedule, but also the experience of the team. So, you know, lender puts a lot of onus on the QS to confirm that they believe that that team can deliver that project. So it's really important to be prepared for those meetings. But the key difference here is that when you buy a site that perhaps falls under MA and is available for permitted development, there's a good chance the agent knows that. There's a good chance the seller knows that. So the value of that site, it all of a sudden is increased. So what it is on a commercial basis, especially post-COVID, you know, perhaps where it's maybe falling into a bit of disrepair, or, you know, it's had voids and tenancy breaks, you know, the value of that site without the benefit of conversion is very limited. Whereas, so the price you might pay for it probably has a bit of that hope value, that permitted development value baked in. Yeah. So, but the lender will value using the VP value, the vacant possession value, unless you have the prior approval. Yeah. So prior approval is when you permitted development. It's not guaranteed. That's, you know, that's a misconception, and lenders will always go to that default mode of it's not guaranteed. I mean, there's a huge high percentage chance it's going to happen, especially if you're not doing any external modifications, but it isn't guaranteed. So the sort of smart people in this space tend to exchange or buy on an option, seek the approval, and then delay completion to use that higher valuation. Okay, because if the lender's valuer goes in, let's say you've agreed to pay 800,000 for a site, and the lender's valuer goes in and you've not got the prior approval, you know you're going to get it. The lender's value is good and says the vacant possession value is 500,000. then the lender is going to lend 60% of 500,000, not 60% of 800,000 on the day one loan. That's if, you know, that is their cap. So huge difference, huge difference. 60% of 800 is what, 480 versus 300. So 180,000 difference just by not having that prior approval. So it's really key to get that, to make sure everything else works. So we just highlighted some examples there. So, you know, if they discount to say 50% of the value, and then they lend only 50 or 60% LTV at 60%, you're actually only getting 30% of the purchase price. There's a huge difference.
You've also got to bear in mind that the day one valuation is based on well, there's two values. If you do hold on and get an option subject to planning, your valuation is still based on what you could do with that property. So you would be better placed to get a rough guide to how many flats you could create, because the valuer does what's called a residual valuation, which is basically saying, if you got 38 flats in this block and if they sold for 38 million, then I think the day one value is going to be, you know, 10 million. If you only got 28 flats and the GDV was 28 million, then the value is less. So you do need to sort of guide the valuer on what your intended plans will be. And therefore, it's better if you wait for the prior approval, then you can design the scheme, then you can get it valued based on what you're going to develop.
One of the other guys in the office, actually, Matthew, he had that not so long ago, where the borrower had purchased based on 7 flats, I think, and then it actually turned out that he could only get 6. So he'd effectively overpaid for the site because, as Tim said, worked backwards from the GDV of 7, and the residual land value was here. And actually, when you work back from 6, the residual land value is here. So you had to go back and renegotiate the price. And actually, I mean, he's successfully done that. I mean, probably not to the level that he would have done if he'd known at the outset he'd only get 6, but he'd been able to reduce it slightly. So, but he's still taking a little bit of hit on what originally he thought his profit was. So it is really key, you know, to get, as Tim said right at the top of the call, really to get an architect involved quite early on, just to ensure that your thinking aligns, because person selling the site might tell you, yeah, 7 flats, no problem, where, you know, an architect is going to give you a much better view on especially if they know the local planning policy and you know, spacing standards, then they're going to give you a much better steer on what's possible.
Yeah, because permitted development is not a defined number. It's just the right to convert it to resi. You can put it anything. You could make 1 big flat, 4 small flats. It's up to you. So take advice on maximisation, use of space.
Okay, so next slide. So what we've done here is we're just working through the same numbers we had on example 1, but we're talking about if the vacant possession value is used rather than the prior approval. So let's say a valuer gives the VP value at 1 million rather than the purchase price of 1.8 million. Okay, and that is possible. Like, you know, a vacant office building today,
alternative use.
Yeah, you know, no tenants, no income, no investment value. You know, bricks and mortar value as it stands today, that it could easily come down that far, no problem. Lender 1 can only lend 60% of day one value. So actually they're lending 600,000 and you're buying it at 1.8 million. So total loan available 2.05, deposit increases from 720 to 1.2 million plus purchase costs. So, you know, you've gone up £500,000 there just because of that differential in the VP value. And as I've said there in the sort of 4th bullet, you know, a lot of this lack of awareness scuppers a lot of would-be property developers. So don't fall foul of this. As we said on the previous slide, way to sidestep this is to exchange or option the purchase and get the landowner to allow you to apply for the permit and then complete when the permission is granted. The risk then, of course, is the owner expects a premium, or is thinking she might do it themselves. Yeah. Tim, I'm just going to switch over to the platform in a sec.
Yeah, I was just going to say. So the only thing is, yeah, the vendor does want a premium because it's an oven-ready deal when he completes. But you should still build in some profit for you for getting the planning. So you don't offer him 100% of what it's worth with planning. Offer him, 75, 80%. Give him something for his allowing you the option if you have to, but never go with a full market value with planning. It's costing you money that you can't get back.
Yeah. Okay. So just gonna switch.
We've got a pop up on the screen here, and it said this is better than the paid courses and trainers he's had. Okay. One of our listeners. That's very nice. Thank you.
Yeah, this is one of the points. I went to one of these. I was invited to one of these property courses, and the person taking the course, I'm going off on a bit of sideline here, but the person taking the course is someone that's very well known in the space and charges people thousands of pounds for the privilege of listening. And this person's knowledge on finance was, quite frankly, unbelievable. Like they knew nothing. And you just think, if that person actually knew a bit more about funding, they'd be a lot farther ahead than perhaps where they were. And I don't mean that nastily. Like, he probably very much enjoys what he does, but certainly, the schemes that he has in the property, assuming that he wants to manage, large portfolios, he'd be much further ahead than where he was if he understood funding correctly. And I think it is, for me, finance is opportunity, right? If you understand this space, you have a competitive advantage over pretty much anybody else in this space, because the vast majority do not understand it. And so as an advisor or a property developer, if you understand it, you can really add value. And we've got countless examples of people. Tim's just working on a deal at the moment, which an accountant sent into us, and the borrower is saving 400,000 in terms of his upfront deposit. It's a pretty big number, isn't it? And the interest rate is comparable to what he's been offered before. But 400 grand on a scheme, is the difference for most people between doing it and not doing it. Okay, so I'm just going to try and move over to the platform now. So do let me know whether
you are showing it.
Oh, is the platform here? Yeah.
Yeah, you're up on loan results.
Okay, cool. Right. So what I've done here is I've done two searches, and I've done one as a new build. Okay, that's wrong. I ticked the wrong box. Okay, so new build. So what we were saying before is normally with new build, your land price is going to be low in your build cost. So what I've done here is I've got two tabs open, two searches, and what I've done is I've used the same total costs in terms of purchase price and build costs. The combined amount is the same. GDV is the same. But just showing you when you invert those figures, i.e. the land cost is greater than the build cost and vice versa, what it actually does to your deposit size. Okay, so we've got £1 million here. We've got purchase costs of 50,000. So that's these things, stamp duty, legal costs. Okay, you then select your region. So we're in the Midlands today. New build. We're selling this residential. We're building flats, and there's 14 of them. Okay. My build costs are 2 million. My contingency is 7.5. Saying gross internal area is 12,000 square feet, which comes out £180 a foot. My professional costs and charges, which is all of these things that aren't a core construction cost. So anything else goes in this box here. Normally on a new build, it's going to be 8 to 12% of that number. Okay, so that's 150,000. We've got a GDV of 4.5 million. We've got a build term of 12 months, loan term of 18 months. If you have a loan figure in mind, then you put that number in there. But if not, you just keep it as maximum loan and you search loans. Okay. So we've got 26 different loan options, okay, that have come up there. And we rank loans in order of the smallest deposit first, okay? So you can see here that this scheme would require deposit 406,000 with this lender, 506,000 here, 551, so on and so forth. But the key to understand is, as you get right down towards the bottom, if I'm speaking to Barclays, I need a deposit of 1.2 million to do the scheme. Yet at the top, I only need 406,000. You know, that's a big difference. And, you know, it's certainly an eye opener, I know, for a lot of our users. But so bear these figures in mind, 406. Now, I've done the same again here. And let's say, right now, this is a permitted development scheme. So I'm paying more for my land, got 2 million. Purchase costs are 100,000 this time, so slightly more, but, you know, it's 50,000. It's not really going to play with our numbers too much. We've got 1 million of build costs this time, and we've got professional costs and charges. Let's change that to 150,000, so it's the same as it was on the other. GDV is 4.5 million again, and we've got 12 months build term, 18 months, so all the same. So now we have to put in nearly 600,000 on this scheme, 700,000 on that scheme with this lender. So it gives you, a clearer indication of, you know, where the differences lie. So, you know,
instantly you can see in the land loan 1.4, they are capped at 70% of land cost, every one of them. Yeah. But their gross loans are different. They're doing 100%, 70 and 100. So their interest rates are different. But that's what we mean by day one cap. They're not going to do more than 70% of the purchase price or valuation. 1.4.
Yeah. So, you know, you have a check eligibility feature here, which is really useful. Lender snapshot. So this is useful for people to know. Lender will consider lending to first-time developers under the right circumstances. So if we go back here, this lender will only fund properties in London, Manchester and Birmingham. This lender needs borrowers to have completed 2 or more previous developments. Okay, so, you know, these guys are off limits unless you've completed 2 or more previous developments. This lender will consider lending to first-time developers under the right circumstances again. So if we go to check eligibility, we've got here, look, max loan to cost 85%, day one LTV cap 70%, max loan to GDV 65%, interest rate is fixed for the period of the loan, level of personal guarantee 20%, will require a minimum of 10% of total costs from shareholders. So every lender has a different view on investor money. So this is really useful information. So for instance, if I go to here, we'll consider 100% of total deposit from investors. Okay, so what we're saying there is that you've got 2 lenders that are offering you almost identical amounts of money, but one lender will want 10% of total cost from you. The other will accept up to 100% from investors, and therefore you're not putting any of your own money in. As a first-time or novice developer, they're probably not going to allow that, because they want some of your own money in, but certainly for an experienced developer, this could be an option. Okay. What we've got here as well is the max pound per square foot, houses, flats, unit prices, you know, what their value, what the end values can be, where they're linked to individuals, companies, overseas, first-time developers, permitted development rights, yes. Air rights schemes, yes. Listed buildings, yes. Modular, no. So that information is all there for you. If you want to compare a few lenders side by side, then you can. So let's say we're going to compare these 3. You can compare up to 5, but let's say those 3. Then you've got there, as you can see, what the differences are. So these are all estimates of these costs, but you can see how it's been broken down, where the differences are between each lender. You can see here the return on capital employed. So that's a key number for most people, 83.06%. So that's with assets on this particular deal. So when once you're happy with your lenders, then you hit proceed, and you go through to the dashboard, project appraisal, and you then go through these 4 modules. Okay, so the case overview is information, and this is to get the loan approved. Okay, so what we've seen on the previous screen is what lenders should lend to you based on high level information, where the project is, the costs, etc. What we now need to do is establish your experience and your and more details about your project. So this is super easy to do. We can do this with you on the platform. We can do this on, send us the information, we'll do it for you. We'll do it with you on a screen share, or you can do it. We can check it afterwards, whatever you prefer. Some people are very competent and confident with tech. Other people, big technophobes, and they just want to send us a development appraisal. We can work all ways. So you've got your ownership here. So whether it's a limited company or something different, you've got your site details. So you put in your address, whether you own it, whether it's an option, regular purchase, planning. You can upload your own planning documents there. Talk a bit about who took the plan, if you took the planning through, what the process was. Did you put in a pre-app? Did you put something in that was refused and then it got changed? All this kind of softer information that lenders like. What would the site look like when the loan completes? Is it a vacant building? Is it bare land? Is there demolition needed? Build procurement, big thing for lenders to understand. Design and build, traditional contract. So an architect and a contractor, or design and build all done in-house by one contractor. Self-managed, so you're managing that scheme and you're subbing out all the individual packages. That is only really going to be available if you've done it a few times before, or you have a construction background. So if you're project manager, site manager, and you've done that, your whole career, then lenders are obviously going to gravitate towards that. Deposit source, so who it's coming from. Exit strategy, guarantees. So, all lenders expect personal guarantee, as everyone I'm sure knows, but there are ways around that in certain cases. Corporate guarantees, cash on deposit. Exit strategy, so are you going to sell, are you going to refinance, bit of both. When you want to complete, do you want a mezz quote, and then what your preferences are. So you say biggest loan, best pricing, and these tend to be the order they carry, and I think great customer service tends to be last. But and then if you've got any lenders that you don't want to be approached, and any further information you think is pertinent. But if you know what you're doing, I mean, I rattle through one of these in about 10 minutes. I think Tim's probably the same. But it is very straightforward to do. And then if you go back to the dashboard, you've got ownership. Which is a bit more about you and your fellow shareholders. Track record, so you add previous developments. So if you've done one before, add it in here. The beauty of this is it lives in the platform. Once it's there, then that is your CV, that is your profile. Every time a lender logs into one of your cases, that will already be there. You can upload your own as well, so you can just click there and add your own CV if that's what you prefer, if you've got it in a nice format. You then your development appraisal. So again, you can upload your own or just use ours. So we've pulled through all the details from search. You just got to put the address in. We've got our build costs here. So you can break those down further or just leave it as one lump sum. And then we've got our sales. So you might want to put in some marketing costs, agent fees, etc. And then the final thing we need is the development schedule. So again, you can upload your own, or just use our rows here that are already for you. Once you've done that, there's 2 optional modules. A lot of people are using these because it's a good way to get other people in your team to participate. So your professional team, again, upload your own. But if I want to add in my architect, then I can put his details in and ask him or her to basically log in and add details they need. So you might say, can you add drawings into the portal, and they can come down here and they can decide what they want to add. Okay. Comparable properties, we're actually building up. You can add your own in at the moment, but what you will be able to do shortly is actually have a live feed from property portals for comps, and you can tick which ones are good, which ones are bad. So that's coming in the near future. But once you've completed these 4 modules, then you hit request a review. That comes to us in the office. So you'll either get called by me or Tim or Matthew, and we'll call you once you've gone through the case, and we'll say to you, we'll sense check it, we'll say, right, okay, this is something that you shouldn't be saying to a lender, or this is something that you've talked about but haven't really expanded on. Let's get more of that in, just to put you in the best possible position for a lender. So we make it as lender friendly as possible. Once we're happy with it, we approve it, and then this button will come live. We submit that to those lenders on the previous scheme. So as I said, you can select up to 5. Those 5 lenders will all receive an email saying, new case to review on Brickflow. They log in, and then they submit their terms on the platform. Once all those terms are back, you decide which one you want to go for, and then the application is managed through the platform. So we've condensed what is for most people a sort of 4 to 6 week process, 20-30 hours over a period of weeks of searching the market, and then applying to one lender, perhaps getting declined, applying to another lender. Every lender on here agrees to the same application process. If you complete the application once, it can go to any lender. There's no differentiation, which is great for you because it's a big time saver again. So you've got the search, which hopefully, as you've seen, takes about 2 minutes. You've got the application process, which, if you know what you're doing, takes about 20 minutes, but maybe 35 for first timers. And that's it. You're done. You've got the best terms in the market, and away you go. So for smaller developers that don't have a finance function, this is a great way for them to make sure they're getting the best finance each time. So that's a quick tour of the platform. Let me just whiz back to our presentation.
I'll just jump in 2 seconds. I've got 3 or 4 questions from the chair. We'll take them at the end, so don't think we're ignoring you. I'll do them live when we've finished the presentation.
Okay, cool. And am I back on the screen now?
Yes.
Okay, cool. So which lenders fund permitted development? Okay, so most bridging and development lenders will fund permitted development. Some bridging lenders are still pure bridging, so they'll do more of the refurb, but the majority will do permitted development because, as we've said all the way through, it is glorified refurb. I can't think of any that don't really like permitted development, Tim.
No, not in isolation. No, definitely not. No,
so I think the majority will do it. Our sort of thinking on this is that if it's a bigger scheme, and normally we say bigger than 4 units, or there's any kind of new build to it. So if you're going up on the old PD rights where you could go up a story or 2, then certainly use a proper development lender. And the key differences is that a bridging lender that perhaps isn't used to their bread and butter, their core business is not development, then if there is a problem along the way, and there normally always will be, because things do go wrong, with a development lender, you can call them up and you can say, well, most of them, you can say, look, I'm facing this problem, what do I do? And 9 times out of 10, you're going to get a pretty good response, depending on, of course, what the problem is, which is going to be, look, this has happened 100 times before. This is what you do. Come back to us when you sorted it. If you need any more help, we'll support you. We'll be outside. Bridging lenders, perhaps if it isn't their core business, you might find that actually they get a bit more nervous, they get a bit more trigger happy, and perhaps your next drawdown doesn't arrive on time until you've sorted things out. So there is a definite difference. Certainly the experience of having worked with both, I think the experience is much better with a proper development lender when you are doing the bigger projects. So that's just really just to confirm what we've just said. I think this is a key point. So development lenders, whilst they will support PD, often a lot of them need a minimum loan of 1 million. So smaller PD schemes, you might find actually a proper development lender isn't available. In that case, we do have our minimum loan on the platform is 150,000. So when you do your search, if you're doing a smaller sub-1 million search, you might find that you don't have 29, 30 options coming up. You might only find that you have 12, 15. They're all still good lenders. They are, as I say, that they are development lenders. So that, the quality is still there. Tim?
Yeah, I've had that a couple of times recently. Further out, maybe the southwest, maybe the northwest, where the client's looking for a loan of 250, 300,000, and they wonder why they've only got 10 options. And it's either geographical, because a lot of the London-based lenders, not a lot, but many don't like to go past Bristol down the southwest. Some won't go to Scotland, for instance, and then double that up with the lenders that don't lend less than 1 million, and that's why the options are limited. But I'd still say for all of these guys, you've still got 10 lenders that want to lend. That's more than you thought you'd have. When you just go to your broker who gives you 1 or 2 options, we've given you 10 definite leads, and that's a far better experience.
So hopefully you've already seen, we're coming to the end now, so hopefully you've already seen from the platform what it does, how it can help you source the best funding each time. So we've just given you a quick overview of the process. So one application process for all lenders. We're connecting lenders and borrowers digitally, which is obviously a lot quicker than the old-fashioned way of getting on the phone like my mum used to do with her car insurance. We then have a deal forum where each lender is invited to submit a bid, which means that you're creating almost a tender process like you do for your build costs, which keeps lenders, make sure that they're giving you the best terms. I think every lender would be guilty of this at some level. Someone comes to them, let's offer him this, and if he screams, we'll drop the rate a little bit. You get best terms straight off because you've got that competitive element. We collect 121 different data points from each lender. Tim manages all of that himself, so please do use that information because it has been hard won. It's taken us months, years to collate all of that information, so do use it. And as you saw already, we index lenders in order of the biggest loan first at the cheapest price. So where the loans match in terms of pricing, loan size, then they'll be indexed in terms of cheapest first. So just start at the top and work your way down. These are some of our lenders. I'm not sure if that's 100% up to date, and there's probably a few more to go on there. But they're all the names that most people would know. Obviously there's some big players on there, and then there's some smaller outfits that are no less more qualified to lend to you, but just perhaps don't have the brand name, the presence that some of the bigger names have, and therefore are more grateful for the business. So there's certainly definitely a customer service element to that.
And I can vouch for most of them, having worked at a fair number of them in my career.
Yeah. And also I think the point there as well, Tim's making, is we're well connected with each of those lenders because everyone knows Tim. I mean, most of the guys know me as well. And what it means is that you're dealing with the right person. You're dealing with someone senior that can actually make a call on things. If they need to bend the rules for your case, then they can. But more importantly, it's quick decision making. So if something does come through, and the lender can't do it, it's a quick no, because they've got all the information there in hand, come through to them on an email. They can quickly. I mean, speaking to Barclays the other week, and they were saying, with our cases, they can effectively look at it within 45 minutes, decide that, and offer terms, within 45 minutes and say, yeah, this is a loan we can do. Whereas normally they say that process is normally 2 weeks because you get through a development appraisal on a spreadsheet where the sums don't add up. the information about who's going to own it, what the planning is, etc., is not there. It's then back and forth with the developer or the introducer, and then it's a 2-week period actually getting all of that information to them. And then, you know, you get to that, and this is how I always think about it, is like, imagine if you're a lender who knows that 96% of inquiries are going to go nowhere, and you've got one inquiry that comes from us, which is beautifully packaged, all the information you need, and within 45 minutes you can say, yeah, I can lend on that, here's my term sheet. Or you've got somebody else where you've got to go back and forward 30 times over 2 weeks. You just get to the point where you think, why bother? You know, and I think people need to understand that is that, you know, lenders are human after all, and you know, it's the path of least resistance, isn't it? It's like, you know, I've got to do 5 loans a month as a lender, you know, as a person within my lending business. You know, if I get 5 loans from Brickflow, I'm probably going to do those 5 than the other, you know, 100 I get from, or 95 I get from others where they haven't bothered putting together the information correctly. So, no, it is a real, you know, you do get a lot of goodwill, I think, by, you know, spending that time, which we've done for you to create that process, which means that you get they get all the information they need quickly and efficiently. A few case studies on screen of recent developers we've worked with. So you know, give you an idea of the kind of savings we're making for these people. John, I think, is going to drop in the chat a meeting invite. So if anyone wants to have a chat with myself, Matt, or Tim, then you can book that. And thank you for listening. And thank you for joining us.
So the questions I've got, and I'm going to choose the order. The first one is the easiest. Is there a typical time frame from submission to offers?
From, you mean in terms of going to lenders?
I would suggest from the initial search to getting your AIP, your agreement in principle, what are we saying, between 4 hours and 24 hours?
Yeah, once you've gone through the, I mean, I would say it's 4 to 48, I think, is what we sort of publish.
Okay. Right.
So once you've completed the appraisal on the platform and you hit submit to lenders, the quickest offers will come back in a matter of a few hours. It might take up to 48 hours for all 5 to come back. Can also depend slightly on whether, you know, if it's a Friday afternoon, you're probably not going to get them back over the weekend. Also depends on each lender. So, you know, if the person at that lender is responsible for looking after that case is on site meetings for a day or 2, or if it's a, you know, particularly large or complex case, then it can take a little bit longer. But the vast majority certainly are coming back in that time frame.
Okay, a very pertinent question, given that you were showing the searches with the lenders' names. One person has shown they know exactly what they're talking about. Is the lender shown, or is it just our levels?
Yeah, so that is the admin function. So we are working on that. So the difficulty with showing lender names is that then from the lender's perspective is almost saying that that's a quote, and it's not. So unlike Money Supermarket, where your insurance quote plugs directly into the lender insurance quote engine, or sorry, the insurance quote engine, and you're getting a direct response from their search engine, which provides that quote. We're not doing that. So what we're doing is we're taking the criteria and the pricing that the lenders give us on a regular basis. As I say, Tim manages that. And we're basically giving you estimates of what each lender will lend to you, both at the amount and obviously the pricing. Okay. So what we do deliberately is try and be on the low side. So the lender says, look, our interest rates are between 7 and 7.5%. We tend to go towards the top end of that range. So there is normally room for a bit of improvement on these rates. So what you see on the screen, hopefully will get better, but there is a lot of subjectivity to development finance, as most of you I'm sure know. So your experience, more details on the project are needed before it's a finalized quote. So the answer to your question is if you log on today, you wouldn't see the lender names, and primary reason for that is that it's not a quote. But once you complete your project appraisal and you submit to those submit to the 5 lenders you've chosen, when those quotes come back, then you will see the lender names. That's what's fed back to you.
Okay, George has asked, what are our fees for a £2 million transaction?
Okay, so George, we charge a commitment fee of £995. That's on all loans at any level. We receive a commission from the lender, which is baked into the results that you see on screen. That £995 is refundable on completion or in the event that the lender doesn't sanction the loan. Yeah. The only time it wouldn't be refundable is if the lender doesn't sanction the loan for reasons of non-disclosure. So if you've gone through the process and you've neglected to tell us that you're bankrupt at the moment or a former bankrupt, and the lender says we cannot lend to this guy, or you took a contractor into administration 2 years ago with £100,000 bill to HMRC, then at that point we wouldn't be refunding the money, because it's not being done in the right spirit of things. But providing the information you provide is true and accurate, there's no reason why you shouldn't get that loan approved. And if it isn't, then that money comes back to you. But also, if you want to then just go to the next lender on the list, then that's obviously just done at the click of a button.
Okay, so Nigel Thompson has asked, does the lender take into account the borrower's personal financial circumstances, such as credit rating, personal debt, mortgages? The answer is yes. They would always they always ask for an asset and liability statement. You will be asked to give a personal guarantee, and they want to know whether you've got substance or wealth behind you to support that guarantee should there ever be called upon. So they are asking, if you live in rented accommodation, you've got no assets whatsoever, your guarantee is technically worthless, and it wouldn't receive a good as hearing as someone who's got a couple of buy-to-lets and their mortgage. So they're not worried that you've got debt, they're just looking to see what your net worth is, and we always ask for an asset and liability statement when submitting your application. Yeah, and the asset and liability statements in the platform, I read that question actually slightly differently to Tim, in that, yes, the A&L is what the lenders need to support the personal guarantee. Personal guarantee, by the way, we can perhaps talk about this another time, and there is actually a really good article on the platform, on the Brickflow website, which tells you more about them and how they work. But they are conceptual security, they're not actual security. So a lender is not taking a charge over a property, but what they're saying is, in the event that something goes wrong, you guarantee to make good that loan up to a percentage amount. And what they want to see is that you actually have assets to make good on that promise. So, but how I read that from Nigel is more about personal circumstances. So, in terms of like CCJs, missed payments, things like that. What lenders generally, with a regular mortgage, you very much have slotting with risk, and it's basically like you're either grade A and you've got no misdemeanors and you're employed and it's 4 times salary and all of that, with a residential mortgage. And then you have like every slot down from there. If you're self-employed, you're a different slot. If you have credit misdemeanors, if you're self-employed, credit misdemeanors, blah, 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 blah. With development finance, lenders generally are a lot more flexible. And if you speak to a lender, and they probably would never say this to anyone else, but when you speak to a lender, they kind of expect some developers to have some kind of misdemeanor, and it is normally just an admin thing. You've got another property, tenants moved out, the bill's been put in your name, you've not realised, and it's gone to a CCJ or a missed payment. You've got a buy-to-let mortgage, the bank account that no one had put money in there, and you've missed a mortgage payment or something like that. As long as these things are explainable, then generally speaking, lenders on developments are a lot more flexible. So there's no computer says no. It is a lot more subjective, which is part of what we talked about already, why that first screen can't be a quote, because there's a lot more subjectivity that comes into it. But we've had former bankrupts. I've certainly worked in situations where former bankrupts have got loans,
And they were wiped out in 2008 after the credit crunch.
Yeah,
and
just about to say,
yeah, lenders are sympathetic to that. A lot of people were. A lot of good developers worked out in that. Worked out. Taking a company into liquidation with outstanding debts. Again, if there's a good explanation, one of their biggest contract at the time decided to not pay them. So as long as there's an explanation, lenders generally will be flexible. They're underwriting the asset first, and your ability to build it. Your credit comes secondary to all of that.
The top question was Kudo, which was quite an interesting one. And what would you advise buying PD sites at auction? What factors need to be considered, and how would you structure it? I think auction is a minefield for a lot of people. It's basically you've exchanged at auction. You have to complete within 28 days or 6 weeks if we had in COVID. But PD at auction, has it got PD? Are you just buying an empty commercial with hope? Will you get planning before you have to complete? No, because it could be 56 days and the auction is 30 days. So loads of factors to be considered, but we can get you bridging finance.
Yeah. I think I echo all of what Tim said, really. For all the problems we talked about today with funding, if you haven't got the prior approval, if the lender's going to use the vacant possession value rather than the prior approval value, then you might pay a much higher figure than what the vacant possession value is, which is fine when you get the prior approval. But in terms of funding, in that sort of 28-30 day window that you're going to have after an auction, you need to be confident that you can purchase cash. I mean, almost certainly you'll be able to get a bridge at some level, but it's very difficult to know what that level will be. So I would run a search on Brickflow based on the permitted development value and build costs and GDV. So run a search as if it's got the prior approval. That will give you a really strong steer on the funding that will be available to you. And then you probably need to work on the basis that if push comes to shove, you can complete in cash. But let's say, for example, you pay 800,000 for a property at auction, and the lender gives it a VP valuation of 500,000. You'd expect a bridging lender to be able to give you maybe 350,000 against that VP value. So, as long as you've got that difference in cash, and then what you'll find is once you get the prior approval, the value then might go from 800 to 1 million, say. The lender might remortgage, the development lender might let you go up to 600,000 day one and 100% of build cost. So you'll get your money back then. So really just plugging that gap really between auction completion and prior approval, which should only be 56 days from when you serve the notice. So if you've got 4 weeks for the auction completion, you've actually got another 4 or 5 weeks till the prior approval should be through, in which case you'll be able to re-gear at probably a higher level. So it just requires you being really organized. You want that development finance to be set up and almost kick in immediately as the prior approval comes in. So you're not carrying, equity or putting equity in for longer than you need to.
Yeah, I mean, my good client and hopefully friend Jetmere is a participant tonight or an attendee. Jetmere will tell you he went to the auction with a guide price of 100. He was going to bid 200. It sold for 420,000. As a lender, if anyone comes to me and says I'm going to buy at auction, 99% of me says you're never going to win, because there's always someone in the room. So don't get excited about getting a bargain in an auction. We all know it doesn't happen, but as Ian said quite rightly, make sure you got the cash to buy it, because that's the guy that's going to do the deal. And as one of my favorite developers said, I never buy at auction. I always buy after auction. I go to the auctioneer and ask him what didn't sell, and then make him an offer. That's the best advice I can give you about buying at auction.
Well, if you win in the room, you've paid too much, right?
Yeah, that's it. That's the other one that lenders say. If you've won that bid at auction, you've overpaid. Because you were the highest bidder, of course you have. So it's and what's the other one? People tell me, if you're buy a South London property in a North London auction.
Yeah,
it's a weird one, but it's stranger things have been said.
Yeah, because well, no one's probably gone over the river.
We have got over. There was one more which says, if you were to get a development loan through the platform, do we have any way of linking up with lenders that are interested in rolling it over to a refi, i.e. a buy-to-let?
Yeah, we could do that. I mean, that's functionality we haven't got on the platform at the moment. But certainly if you go into a development loan today and let's say it's 12, 18 months, by the time you get to the end, the functionality should be there. But yeah, it's in the pipeline, but it's not there today. But we can do it offline.
Okay, we're done.
Is that everything?
That was, yeah. If you have substantial assets abroad, will they be weighed against a personal guarantee? Not really, no. It's like saying you've got substantial experience of contracting or construction abroad. Very hard to get a lender to get excited about that. They want to see UK. They want to be able to test it, I suppose.
What you can do there, Max, is if you have the ability to, is raise a mortgage against those assets and then use the cash as a deposit on account. So we did that on a transaction not so long ago where the borrower owned the site, but then lived in rented accommodation and all his money had gone into the site. So the site was worth $1 million unencumbered, but the lender needed something for a personal guarantee. And so what he did is actually just put 10% of the total loan amount on account. So it just sat in an escrow for the duration of the loan. So that could be a good way to do it. You know, if you are short of personal guarantee. Is that everything?
It is, yeah. Nothing else. No.
Okay, John, did we put the link in the chat for meetings? Yeah, we did. Brilliant. Okay, good stuff. All right, ladies and gents, thanks for joining. Thanks, Tim. Thanks, John.
Thank you, Ian, for running it. That's good.